What's going on, everybody? As we wrap up 2025, the data coming out right now is some of the most important that we've seen in years, and it's going to be shaping the Canadian real estate market moving forward in 2026. I want to take a second here to really thank you all for watching along with these videos. I'm going to be creating a ton more content in 2026. The goal is 10 videos a month, so stay tuned to this channel. Make sure to like and subscribe. Okay, let's get into it. Because for the first time in modern history, Canada's population is actually shrinking while rental vacancies are hitting multiple decade highs. Rentals are falling, developers are pulling back, and interest rates may actually be closer to rising than cutting. And at the same time, employment, GDP, and inflation are all beating expectations. So today we're breaking down what this means for investors, homeowners, buyers, sellers, and anyone renewing their mortgage in 2026. So let's dive into it. Population, the big shift. We have to start with population because this is the demand engine behind housing. Now, according to new statistics, Canada data is showing population fell by roughly 76,000 people in Q3, dropping to around 41.6 million. That's the largest quarterly contraction outside of the COVID border closure period. And if you strip COVID out, this is basically the biggest population drop in modern Canadian history. Even more important, annual population growth has slowed to roughly 0.2%, the lowest level ever recorded. So what's causing it? Almost all of it comes down to non-permanent residents, foreign students, and temporary workers. From 2022 through to 2024, the vast majority, like 95 to 99% of Canada's population growth, came from international migration, not neutral growth. Now, that trend is reversing very fast. In Q3 alone, Canada lost roughly 176,000 non-permanent residents, and the total number of non-permanent residents has fallen from about 2.85 million, or 6.8% of the population, down from a peak of around 7.5%. The federal government's stated target is to bring that down to 5% by 2027, which implies population growth near zero or even negative for at least the next couple of years. And for real estate, that really affects the market and it changes everything. For years, housing demand was underpinned by rapid population growth, especially renters arriving faster than supply could keep up with. That's why 2022 and 2023 felt like listed today, rented tomorrow. But that tailwind is completely gone. Let's talk about rentals because this is where the shift becomes obvious. December rental data is out and rents are down again. In Vancouver, unfinished one-bedroom rents drop month over month and are around average price of $2,120. A year ago, that same unit was around $2,300. In Tsawwassen, coach homes were getting $2,200 to $2,400. And as of recently, I've seen them be $1,800 or even less. That's roughly an 8 to 12% year-over-year decline, which is wild. National average rent is down to about $2,074, down 3.1% year-over-year, and roughly $100 below where it was 2 years ago. And vacancy is climbing to record levels too. Toronto's purpose-built apartment vacancy rate is around 3%, and Vancouver is around 3.7%, which is the highest level Vancouver has seen since 1988. These numbers are wild. That's not a typo. That's a 37-year high for vacancy rates. And here's what matters. The wave of new purpose-built completions hasn't even fully hit yet. We have a flood of supply coming while population growth is slowing or turning negative. So the direction is pretty clear. More vacancy, more incentives, and downward pressure on rent. Now this is where I want to add an important reminder. Renting might feel like a win in the short term, especially if it saves you money each month. But long term, the wealth gap between renters and homeowners is absolutely massive. Homeowners aged 35 to 44 that have a median net worth of around $673,000 versus renters around $61,200. That's 10x in difference. And homeowners aged 45 to 54, their net worth is around $972,000 versus renters is around $50,000. Now that's a difference of roughly 10 to 19 times the net worth. So that's absolutely wild. So yes, rental affordability is improving and it's helpful, but if it delays homeownership for years, the long-term wealth gap gets bigger and bigger, not smaller. Next up, let's talk about the jobs report. Headlines look strong, third straight month beating expectations. But here's what you need to know. A lot of the gains in these jobs were part-time, while full-time employment actually declined. Healthcare added jobs, which is absolutely great, but construction, manufacturing, and retail were down meaningfully. And there's another way to track employment that tells a different story: the payroll-based data set, often considered more reliable over time. That payroll measure showed a large decline in jobs month over month, while labor force surveys showed an increase. Both can't be perfectly right at the same time, and that's why the job picture is more mixed than the headlines actually suggest. So what does this mean for housing? It means don't assume strong jobs automatically equals strong housing. That's completely wrong. If employment becomes unstable while population is shrinking, it can weaken demand, especially for rentals and entry-level ownership. Now let's talk about the GDP. Canada posted a strong growth number in Q3, beating estimates, but when you look under the hood, a big chunk came from lower imports, not stronger exports. That's an important distinction. Cutting imports can lift GDP on paper, but it doesn't necessarily mean productivity is actually improving. We also saw housing consumption decline, the first time we've seen that kind of move since the post-2008 era. So again, you'll get this theme. Headlines say one thing, real life feels like something completely different. Now let's talk about inflation and interest rates, because this impacts buyers, renewals, investors, basically everyone. And 2026 has the biggest mortgage renewal wall that we've seen in decades. Inflation is holding around 2.2% year over year. Core inflation measures are easing, and the shorter term trend suggests inflation momentum is cooling, not accelerating. So that's all good news. But groceries are the wild card. Food prices jumped strongly year over year and also rose sharply month over month. This seems like it's actually a pretty big topic among the comments in my videos that I've been posting. And this is why inflation doesn't feel like it's done for most people, because you feel food costs consistently. And this is why the market expectations have actually shifted. Right now, there are no cuts confidently predicted for 2026, and the market is leaning towards the risk of a hike later in the year more than cuts, which is brutal. So if you're renewing in 2026, here's the practical takeaway for you. If you can lock in a rate that protects you from the upside risk, it may be worth considering, especially before the fall, while keeping flexibility where possible. Obviously, things can change, but based on today's data, 2026 is not shaping up like a rate cuts save everyone year. It's feeling the opposite almost. Next, let's talk about new housing starts. Starts jumped month over month nationally, but year over year, they're still down. And the composition matters. Single detached starts are down meaningfully, while multifamily has held up a little bit better, but even that is starting to soften in certain regions, and I'm feeling that locally here in Tsawwassen. In BC, the slowdown is more pronounced in several markets. The big takeaway is this: Canada is building, but not evenly, and not necessarily in the places or the product types where demand is strongest. If population growth is slowing while completions remain high, you get more competition, more choice, and less pricing power, especially in investor-heavy condo markets. So what does this mean heading into 2026? Population growth is no longer a guaranteed demand engine. Vacancies are rising and rents are falling, which changes investor math. Job and GDP looks okay in headlines, but mixed underneath when you really dive into things. Rate cuts are not guaranteed, and the risk of hikes is real if inflation sticks. Home prices nationally have been grinding down in nominal terms, and in real terms, they've already reset in years. So 2026 could mean more of what we've seen: a slow, choppy market with regional winners and losers, and a lot of people needing to be strategic. If you're buying, the goal is to buy the right asset, not just any asset. And if you're selling, pricing and positioning matters more than ever. If you're chasing the market down, you're just shooting yourself in the foot. And if you're renewing, don't assume rates will bail you out. That's it for this one. If you want more breakdowns like this in the future with real numbers and real world takeaways, hit the like, hit the subscribe, and drop a comment with your city where you're from. I'm super interested to see where my viewers are from. And I'd love to hear what your predictions are for rates going forward in 2026. Thank you so much for watching. I really appreciate each and every one of you. I'm Blake Chancey with Real Broker. Until I see you next time. Peace.